everyone, welcome back to my channel. In today's discussion, we're going to be talking about inflation. What is inflation and where is inflation going to end up in the future with this crazy environment that we're experiencing today? So I found this paper, The Ultimate Guide to Inflation by Lyn Alden, and it basically breaks down what inflation is, the different types of inflation, and where this person believes inflation is going to go in the future. So I thought it was a pretty good article I'd like to share with everyone. So what is inflation? Inflation is a controversial and complex topic. This article looks at 150 years of data across multiple countries to provide a general idea of what inflation is, what to look for, and how to invest with inflationary and deflationary risks in mind. Here's some definitions of inflation. The basic definition of inflation is continuing rise in a general price level, usually attributed to an increase in the volume of money and credit relative to available goods and services. In this article, they talk about the three different types of inflation. First, inflation is monetary inflation. Monetary inflation generally refers to an increase in a broad money supply. In other words, it's not about prices going up, it's about the amount of money in the financial system going up. So this is basically when you hear all these articles talking about printing money, the printing press is going wild, helicopter Ben Bernanke. When they start printing a lot of money, it's going to cause inflation because there's more money in the system that's able to be used. They've got some pretty good charts in this article you can go over later. I'll post a link in the description below. You can read this article in full. I'm just going to go over the highlights of some of the stuff I find is interesting. There are two main forces that drive up the broad money supply over time. Either banks make more private loans and thus create new deposits, or the government runs large fiscal deficits while the central bank creates new bank reserves to buy large portions of the bond issued associated with those deficits. Once again, a whole bunch of charts. It goes into more detail. I'm just going over the basics, not to get too in-depth into the subject. It goes into instances like between the 1940s and 2020s. It was the government deficits that drove up the broad money growth rather than the private sector loan growth. Monetary inflation is generally a starting point for the next two forms of inflation: consumer price inflation and asset price inflation, which we feel more directly. Consumer price inflation is when the normal price of the broad set of goods and services goes up. In other words, if you paid $4 for a Big Mac 5 years ago and $5 for a Big Mac this year, then it inflated 25% in a price at an average annual inflation rate of 4.56 during that period. Some goods or services can have a unique supply and demand balances that affect their price. So we can't focus on single goods or services when measuring inflation. When a majority of goods and services start going up in price, that's consumer price inflation. The value of that currency itself is what is losing purchasing power in that case, rather than a specific product or service going up in price. Governments use a hedonic adjustment to adjust for this, but naturally is prone to debate, so we already have an area of controversy. So what this is talking about is they've changed how the government determines the actual inflation rate has changed over the past 100 years. The governments always want to make it look like they're doing better than what they are. So what they've done is they've changed how they measure inflation for the number you see. So anytime you see a consumer price index or inflationary rate of 2%, 0.8%, or 4%, that number has been changed, and it's not the same number you would have saw 100 years ago. So the numbers have changed to make the government look like it's better, doing better than what it is. So inflation, in general, they're only using certain products to calculate the inflation rate. As of the time of this recording, most energy, real estate, and food prices are not counted in the inflation rate. For example, a 2x4 a year and a half ago cost about $1.88 for one 2x4. Today it's $6.88 at a minimum. Some places even higher, as high as 8 or 9. So if you look at those numbers right there, that's way more than a 4% increase. That's about a 400% increase in the last year and a half, just in building materials and lumber costs. They're not using the lumber costs to determine the inflation because it would skew the results and make the inflation numbers look higher. So they just admit that number altogether. Same thing with food. The average food increases have been about 10 or 15% over the last year or so. So they're only using certain foods. They're picking and choosing what numbers they're putting into the inflation rates. That's why as you go to the grocery store and you notice your bills have been about 20% higher, 15% higher over the last year, year and a half, but they're only advertising inflation rates going up about 2%. You can see the difference in numbers there. They're not using everything. They're only using specific goods and services that they believe are that they believe are the best. And that's why if you look in the article here, you'll see that it's an area of controversy. So quite often, consumer price inflation is tied to a commodity price inflation. If oil, copper, lumber, and other key commodities are abundant and cheap, it puts downward pressure on most types of prices. On the other hand, if there are supply constraints of major commodities relative to demand, then commodity prices go up a lot, and that trickles into other prices because the cost to make them and transport them goes up. This chart shows the consumer price index of the commodity producer price index since 1913, which is when the Federal Reserve was founded. We can divide the period since the ratio into two halves due to significant change in monetary structure that occurred in 1971. If you see in the chart here, you can see in 1971 in the green text, it says Nixon goes off the gold standard. When Nixon went off the gold standard, that completely changed how everything was measured. So the basics of what that means is we used to operate in a gold standard before 1971. So what that meant is the government could only print as much money as we had in gold reserves. So think of it this way. For every dollar that we had in gold reserves, we can only print $1. There's a lot of controversy behind that. There's a lot of politics at play. A lot of people were lying about how much gold reserves they had so they could print more money. When Nixon took the United States off the gold standard, it basically took the whole world off the gold standard. It basically said, hey, we're going to print more money than what we actually have in gold. And it's not going to be tied to anything. So in 1971, we had a lot of inflation and a lot of problems. Nixon went ahead and fixed the problem a little bit by basically making an agreement with the oil companies saying all oil would be traded in US dollars. So instead of having a gold standard, now we have what's called basically an oil standard because the US dollar is a reserve currency of the world because all oil is traded in US dollar as of today. Now there is some oil companies that are trying to get off of that. They're trying to trade it in the ruble or the Chinese currency. But as of right now, most oil is still traded in the US dollar. So every time we print money, it affects the other currencies as well now. So you can see the inflation rates and what's happening as soon as Nixon goes off that gold standard. So the other third thing of inflation is asset price inflation. Asset price inflation refers to the prices and valuations of financial assets like stocks, bonds, real estate, gold, fine art, and collectibles increasing over time. These are things that have been held for a while and tend to appreciate in price over the long term. Here's the U.S. household net worth as percentage of GDP in blue, currently 600% left axis, and the short-term interest rates in red near zero right axis. And as you can see, as interest rates go down, if you just look after 1971, as interest rates go down, your net worth as percent of GDP goes up. Because when the debt is low, more people go out and spend. Household net worth includes stocks, bonds, cash, real estate, and other assets, minus liabilities like mortgages and other debts. Asset price inflation often happens during periods of high wealth concentration and low interest rates. If a lot of new money is created, but that money gets concentrated in upper echelons of society for one reason or another, then that money can't really affect consumer prices too much, but instead can lead to speculation and overpriced buying of financial assets. You saw that in 2006 with the real estate bubble. Think of it like this: if the government and the central bank were to create $1 trillion and give the 100 richest people in the country an extra $10 billion each with that money, what would they spend it on? All their physical needs and desires are met many times over already. They're not going to eat better, travel more, or really do anything differently in terms of personal consumption. They're going they're already doing that. Instead, they're going to buy more financial assets like more stocks, real estate, and push those prices up with this extra demand. This money won't get out and push the prices of things like copper or beef up. On the other hand, if the government and central bank were to distribute $5,000 to every American adult who makes less than $1 million, which would be in the ballpark of 200 million people, and thus total up $1 trillion in brand new money, then a significant portion of them would spend that money on everyday goods and push up many consumer prices as demands outpace supply for a period of time. This is money that would actually lead to more consumption and circulate more. And that's what we're experiencing today. With all the government stimulus money going out into the world, people are buying more stuff. They're going on vacations. They're buying cars. They're buying bigger houses. So this is what we're looking at today is this. So the government gave out stimulus checks and people are using that money to actually consume more stuff versus if you look at the 2017 tax cuts, which the Democrats say were basically for the left, which isn't really true. The 2017 tax cuts were actually equally divided, but the rich did see a favorable amount of money that they were able to save, in which they actually increased their businesses and they hired more employees and reinvested. They did actually pay more bonuses and took more higher salaries with the money as well, but they also reinvested it. And when you saw in 2017, you didn't see a crazy inflation happen. You saw more jobs happening and you saw a slight increase in inflation because more people were working and the unemployment rate hit record lows. But in the end, you can see the difference between the 2017 tax cuts and then the 2020 and 2021 stimulus payments that went out. You can see the difference in inflation, how it attracts. When you give a whole bunch of money to the upper middle class, and the poor, they're going to use it for consumer goods, which is going to push prices up and cause massive inflation. So that's what that's talking about. So money supply versus consumer price inflation. On the very long run, we should expect technology to continue to improve and push prices down. So what they're saying is this can be a transient inflation. It talks about this a little later in the article. It gives you the definitions of transient, but it's just a temporary inflation is what we're experiencing right now. The thing about inflation is once it starts going up, it very rarely ever really goes back down again. Here's a good chart of price inflation versus money velocity. And what money velocity, all it is think of it as money that's moving around. So the inflation, as you can see by this chart, that's the red line right here. Inflation goes up. You can see as money moves around, it changes and makes the inflation go up. So the more money that's moving around, inflation will typically go up. This goes through a lot of history of different countries of how they have experienced inflation and what they've done. It's pretty interesting read. It's kind of a boring read. Anything with money is pretty boring, but I'm trying to go over the basic parts of how it can help you learn a little bit more about inflation and how you can what to do with your money in the future. So how accurate is a consumer price index? The CPI attempts to accurately report the changing of costs over a representative basket of goods and services. And you notice what it said, a representative basket of goods. So they're picking and choosing which items they want in this basket, and they're manually picking and choosing. So it's not a standardized thing saying, hey, we're going to use all oil or gas prices or electricity. They're just picking and choosing every year what they want in this basket. Over time, some of these goods and services are inflating or deflating in price, being substituted out and being weighted into the overall calculation in changing ways. There have been many changes to the CPA calculations along the way to use more qualifying adjustments. There are many people who believe the CPI, especially due to changes in that calculation over the past few decades, understates the true inflation rate in the United States. And I'm one of these people. If you're going to continuously put items in and out, you're not giving a true analysis of what inflation has happening. If you're going to take out gas one year because it was cheaper and it deflated, then and you don't want that deflation number in there, you're manipulating the data. So the data for the CPI is manipulated. It gives you a broad understanding of it, but the CPI is not the true inflation rate. To continue on with the article, it talks about house prices, food prices, healthcare prices, tuition pricing are all rising faster than your CPI or your inflation. They represent the bulk of the middle class household. Sometimes proponents of this idea are dismissed as inflation truthers since they push back on expert numbers and assert that the CPI is manipulated in favor of a narrative. The moderate and boring conclusion. This is the author's opinion. I think the evidence suggests that in a true apples to apples comparison, the U.S. inflation has been somewhat higher than the CPI reports, but not as high as some folks think. Official CPI says the broad prices rose about 2.5% per year on average since 1990, while this author thinks there's a good cause that's closer to 3% or more. In other words, prices went up more like 150%, 2.5 times rather than 100%, 2 times in total during these 3-decade compounded annual period. Wages barely kept up with inflation. I think everyone knows that. So as prices are going up here in 2021, your wages are not necessarily going up as fast as inflation. So as lumber prices and food prices have gone up anywhere from 15% for the food up to about 300 to 400% for the building materials. Real estate is up this year nationwide at 20%. People have not been getting 20% raises, so therefore you're feeling it in your pocketbooks much more. But anyways, wages are barely kept up with inflation, which is compounded by the fact that more education and thus more student debt is required on average to get the same inflation-adjusted wages. In other words, on an inflation-adjusted and education cost-adjusted basis, median wages have actually decreased. The Big Mac test. The economist has tracked prices of McDonald's Big Macs around the world since the late 1980s. If we look at the Big Mac prices in the United States since 1990, they have trended notably higher than the CPI and have a smaller gap versus the growth of broad money per supply per capita, which is how prices are generally moved in. So here's a pretty interesting chart. This is basically the blue line is your CPI adjusted inflation rate. Your broad money, and then the Big Mac price. And you can see the Big Mac price rises a lot higher than your CPI. And you can use this for pretty much everything. You can look at housing, you can look at your energy usage, your gasoline, your electric bill. You can look at real estate. Everything outpaces the CPI. The CPI number is very manipulated. Back in the late 1990s and early 2000s, commodities were very cheap, so the Big Mac rose in price more slowly than the CPI. Starting in 2003, commodity prices had a big rise up, and Big Mac prices caught back up to CPI, eventually outpaced it by a noticeable margin. The new car test. According to the official CPI for new vehicles in the United States, new cars rose about 22% for this time span of 1990 to 2020. The average price of a new car in 1990 was $15,400. In 2020, the average price of a new car crossed over $40,000. That's more than a 2.5% increase or 150% plus increase in price, during which the new vehicle CPI says that it was effectively only rose 22%. So why is there a discrepancy? Well, new cars got bigger and better. They have more features, more preferences, shifting towards a higher mix of SUVs, so the CPI model discounted their inflation rate to compensate for that. Offshoring automation did help supplies suppress vehicle prices on a quality adjusted basis. So let's pick the Toyota Camry as a direct comparison to reduce the size type changes. The starting MSRP for the automatic was $12,258 in 1990. The starting MSRP in 2020 was $24,425. That's a 100% price increase, almost exactly. That's about 2.5% per year. Certainly, we can allow for substantial amount of quality adjustment in a new car CPI calculation. The new Camry has power everything, a navigation system, better safety features, a better gas mileage, but is the quality size adjustment enough to reduce the actual price appreciation from 100% down to just 22% on a quality adjusted basis during the 3-decade period? As official new car CPI says was the case. But according to the official CPI reports, the cost of the car maintenance has gone up faster than the broad CPI did in the last 30 years, with a roughly 140% increase from 1990 to 2020. Gasoline prices went up around 130%, which were also faster than a broad CPI. The broader test, according to the U.S. Bureau of Labor Statistics, the average American household spends 33% of its money on housing, 17% on transportation, 13% of its money on food, 11% of the combination of insurance and social security and pensions, and 8% on health care, 5% on entertainment, 3% on charitable care contributions, 3% on payroll, 2% on education, 1% on personal care products, and the remainder on other categories. Housing, transportation, food, healthcare, and education collectively are 60% of the expenditures. The combination of the pensions, insurance, Social Security, and charity is 15%. Everything else combined is 25%. The median house, healthcare CPI, and education, childcare CPI all went up faster than the broad CPI, according to the official metric. Food CPI was in line with the broad CPI during the official matrix, but potentially higher according to things like the Big Mac Index. New car prices, as we saw, went up for the same rate as CPI, about 100% increase from 1990 to 2020, or a 2.5% per year, even though their CPI model said they went up extremely slowly on a qualified adjustment basis. Car maintenance CPI, gasoline prices officially went up faster than CPI as well. Overall, transportation spending grew at least as fast as broad CPI. So the majority of things that the Americans spend money on went up faster than the broad CPI. It brings into question the accuracy of the broad CPI. The basket of housing, education, food, healthcare, transportation represents 60% of the total average household spending, according to the BLS, or about 70% of the total ex-pension and ex-charity spending. If 70% of the goods and services exponential basket is going up equal or higher, in some cases notably higher than the broad inflation rate, do cheaper goods and smaller categories outweigh that? It's an interesting question. CPI broad money and selected prices normalized from 1990 equals 100. You can see that chart. House prices versus owner-occupied rent. The biggest expense for most people is their house or apartment. I think everyone agrees with that. So differences here play a huge role in how accurate the inflation basket is. The median house price has outpaced the broad CPI over the last 3 decades. The CPI went out about 2x or 100% over that period, while the median house price went up around 2.8x or 180%. The median home size grew about 15% during that time, but even during the adjusted for that, the median house price per square foot has risen faster than the CPI. The CPI, however, does not include house prices, since that is a capital asset rather than a consumption asset. Instead, they use owner's equivalent rent, where they do surveys to ask people what they think the price of rent the dwelling they have would be. In some ways, this makes sense, but in other ways, it opens up survey errors and introduces financing costs. The big discrepancy in this part is the calculation of whether or not we should include financing into the price of a home when calculating the cost of a home. Since owner's equivalent rent looks at monthly cost, it indirectly accounts to the account financing rates. Using the bank rate mortgage calculator and historic mortgage rates from the St. Louis Fed, assuming 20% down with a 30-year fixed mortgage. Here is a back of the envelope check. If you bought a house, median home income 1990, it would cost $125,000, and you would have a 10% mortgage rate. Your estimated monthly payment would be $1,025. If you bought a median home in 2020, it would cost nearly $350,000, and you would have a 30% mortgage rate. Your estimated monthly payment would be $1,476. In other words, despite the fact that the price of the median house went up faster than the CPI rate, the monthly cost of owning the median house with it leverage went up less than 1.5%, 50% during the 3-decade period, which is less than the broad CPI rate. However, if the item goes up in price by a lot, but the cost to finance it goes down, does that mean the price of inflation didn't happen? The actual collection of the lumber and labor and land that went into this house on an apples-to-apples basis, even accounting for different sizes, is more expensive if you were to buy it unlevered. The bank simply gets a smaller cut of the ongoing cost if it's bought on leverage. The aspect alone can make a big difference on CPI calculations, since it makes up about a third of the basket. The cost of owning the median home throughout the long term of financing hasn't risen much, even though the actual price of the median home has outpaced the CPI growth rate. And similar reasons, rent hasn't quite kept up with CPI over the last few decades in most locations. The landlord has lower financing costs, which keeps her costs lower even if the property itself is more expensive. And so that trickles down to keeping rents from rising too quickly. So this is another discrepancy: the price of purchasing unleveraged property versus the cost of buying or renting that property with leverage using lowering finance cost affects the CPI calculations. Education necessity, one of the biggest price growth outliers, and was with tuition, with 4x or 300% increase compared to 2x 100% for the broad CPI from 1990 to 2020. Decades ago, a 4-year or a 6-year college education wasn't necessary to have strong wages. Right out of high school, young adults could start earning money without student debt assigned to them. More prestigious careers, of course, generally needed higher degrees. But due to globalization, offshoring, automation, and reduced union participation, there's been considerably downward wage pressure on many types of non-college jobs. The median male income has been virtually flat in inflation-adjusted terms over the past 4 decades, but he increasingly needs a college degree and student debt in order to earn the median income. And the cost of the degree has gone up at twice the pace of the broad CPI. This contributes to a lot of people feeling like they're running in place because they are. Wages are not Wages are only going up in line with price inflation, and yet a bigger upfront investment and or ongoing student debt payments is needed to get that income. Outsourcing and automation were fantastic for investors and not great for the blue collar workers. First group got all the benefits without the drawbacks, while the second group, that's your blue collar workers, got some of the benefits, but the full cost of the drawbacks. When you add everything together, middle class and working class have indeed been squeezed. The share of the U.S. net worth held by the bottom 9% of the country decreased from 40% to 30% from 1990 to 2020. CPI accuracy summary. If we approximate the cost of living in the classic American dream, solid middle class life of a spouse, 2 kids, and a single family home, health care, university, a car, annual vacation, and quality meals, I find it hard to match at the reported CPI over the past 3 decades. The big expenditures that make up 60 to 70% of the typical household in annual expenditures went up faster than the CPI and could not have been offset by disinflation in the remaining smaller categories. On the other hand, if someone lives with their parents' home and rents a suburban apartment, skipped university, doesn't have kids, and most of their expenses are on electronics, digital goods, foods, their car, and apparel, then the cost of living probably is accurate reported or quite possibly even overstated by the CPI. Overall, this 1990 to present period has been a recipe for inflation controversy. Labor offshoring and information technology have suppressed wage growth and prices in many categories. While the biggest costs of living can't be outsourced or digitalized, have outpaced CPI. Lower financing costs have kept the monthly cost of some of the big ticket items, like the medium house in check, even though their actual prices inflated at and above CPI rate. On the other hand, a bigger upfront investment in student debt is often required compared to previous history in order to earn a decent income. As a result of all this, broad money supply went up a lot faster than CPI. I think it's supposed to say a lot faster than CPI, and was collected by folks in the top income brackets. There is plenty of controversy about the accuracy of the CPI. CPI says that price inflation averaged 2.5% per year for the past 3 decades, factoring out some questionable parts of the model. A number of around 3% seems more realistic. However, because education debt is required to get the median income, inflation by the end of the day feels more like 4% annualized for many people. And the bottom 90% of the income spectrum are collectively losing pace versus the top 10%. Broad money supply per capita rose at 5% during this time, but a lot of it concentrated in the upper parts of society. Those who benefited from the technology offshoring are the most. Transitory versus non-transitory inflation. You've been hearing a lot about this in the news. You're often hear about policymakers or the media that inflation is transitory, meaning types of inflation occur rapidly and then suddenly cool down. So transitory just means it's temporarily. It's going to go up rapidly, then it slowly will cool off. However, there's a big difference between inflation that is only transitory in rate of terms, and inflation is truly transitory in absolute terms. Inflation is truly transitory in absolute terms would mean that a lot of prices temporarily go down to a temporary supply shock and then come back down when the supply shock is over. Inflation is the only transitory in rate of terms, however, would mean that prices jump up quickly and then stop going up quickly, but never actually come down. And I think that's where we are today in society. We're going to see prices start coming up, and they might come down a little bit. Like, for example, lumber costs have gone up 400% over the last year and a half. And they might come down a little bit, but overall, over the last year and a half, they're still going to be 200 to 300% higher. So the cost of the lumber costs are still going to be a heck of a lot higher. It's going to be a lot more than that 3% rate. And I think you're going to see the same thing on the grocery side and gas prices and everywhere else. You're going to see the prices increase. They might decrease a little, but they're not going to go back to where they were. It goes over the 1940s inflation example. It gives you a chart with the year-over-year inflation rate, and we can see the three big clear spikes of inflation. So you can see the years of where they had a problem, this is the transitory inflation, where the prices went up, but then you saw them drop down close to where they were before the increase. That inflation was obviously very transitory in rate of terms, meaning that it came on fast and went away fast. However, you can see there was very little, if any, deflation between those spikes. Prices went up quickly and then cooled off, but never really came back down. Here's an absolute CPI during that period. Consumer price increased 90% from 1940 to 1952 to a permanent higher plateau. This is something to keep in mind when you're told that inflation is transitory. It's often transitory in rate of change terms, but not absolute terms. With inflation as transitory in rate of change terms, but not absolute terms, broad prices stop accelerating to the upside, but don't come back down. During these times, inflation is often described in terms of supply shortages, and that's true. Those shortages contribute to how fierce the spike can be. However, other factor that is the broad money is going up a lot, and that money usually stays in the system for good, which permanently keeps broad prices higher once it's in the system. So it's talking about printing of money, basically. Once you start printing the money, it's in the system, and it's hard to take it out of the system. It goes into the 1970s inflation example. It's going to give you some charts about that to show exactly what happened there as well with the transitory inflation. And then it compares that again. Talks about hyperinflation, and alternative financial media sources often argue that hyperinflation is always just around the corner. That sort of content draws a lot of clicks and attention, but it's not very productive for managing a portfolio. Hyperinflation is defined as a 50% month-over-month inflation. If that persists and therefore compounds exponentially month after month, that would be well over 10,000% inflation by the end of the year. Hyperinflation often happens in developing countries and nations that lost critical wars. It's extremely difficult, but not impossible, to have hyperinflation even in a developed country that has. Let's try that again. Hyperinflation often happens in developing countries and nations that lost critical wars. It's extremely difficult, but not impossible, to have a hyperinflation event in a developed country that has not lost a critical war. Basically, you need a rather huge collapse in productive capacity as a result of bombings or total social upheaval in order to get actual hyperinflation in developed countries. And this is where I disagree with the author. Yes, in the past, I do agree with her that critical wars is what's caused hyperinflation. After you've lost a war, you've put a lot of money and a lot of spending into something, and at the end of the day, you don't get a return on an investment of your money. But what we're doing today with all this, the government spending, the increased in deficits in the United States, is actually doing the exact same thing without a war. You want to call it a war, you can call it a war on COVID, you can call it a war on humanity, you can call it a war on whatever you want. But what we're doing today is we're increasing the money supply, which is creating inflation. And we're also spending, the government's doing massive amounts of spending, and they're not getting a return on investment of that money. So they're spending a whole bunch of money today. So hyperinflation, while she is saying it's not really going to happen in the United States because we're not really in a war, and it's only the country that loses because they don't get a return on investment on the money, I think that it is a possibility. I don't see it happening. I don't see hyperinflation happening in the United States, but to say it can't happen, I think is wrong. I think everything is plausible. With the current monetary structure in developed countries, hyperinflation is very hard to occur. Changes to the Federal Reserve Act or equivalent laws in other countries can make it more likely, but as it currently stands, investors are better off focusing on normal inflation when it comes to developed countries. We can cross the hyperinflation bridge if it continues to change. Some types of investments that work well in an inflationary environment work well in a hyperinflation environment anyway. In developing countries, hyperinflation is easier to occur. This is because they don't have as much starting capital that's rely on foreign financing. Corporations or other governments in developing countries often owe debts in currencies that they cannot print, like dollars or euros, and are prone to nominal default risk. Who benefits or is harmed by inflation? Outright hyperinflation Outright hyperinflation is bad for almost everyone since the economy can't function properly while it's happening. If you have no reliable medium with which to pay or accept payment, it's harder to offer products and services, especially products and services for which it requires any sort of multi-month or multi-year planning and investment. However, the types of environments that we can think of as inflationary, like 1940s or 70s in the U.S., often do have winners and losers. Usually people use narratives who theoretically would do better or worse in an inflationary environment, but such narratives are often incomplete with the reasoning and don't hold up well to historical outcomes. For example, I've seen an idea proposed that because lower class have most of their savings in cash, while the wealthy have highly diversified into real assets, lower class would be more harmed by inflation. The reason that's incomplete analysis is because A, lower classes also have more debt, which partially gets inflated away with inflationary environments, and B, inflation often occurs because wages are increasing and more government transfer payments are occurring to those in the lower classes, which needs to be taken into account as well. During both the 1940s and 1970s inflationary decades of the past century, wealth concentration went down. So you can see what happened. Here's a chart with the top 0.1% and the bottom 90%, and you can see what happened there. In the 1940s, for example, inflation happened due to massive financial spending to industrialize the economy and fight World War II. The employment rate increased, and the country nearly tripled its industrial base. Technology that was used for the war was then repurposed for domestic use. Soldiers, when they came back from the war, were given all sorts of benefits thanks to the GI Bill, and nearly 8 million of them used the education portion of the benefit to complete the college degrees or training programs. To pay for this, taxes were raised on the rich, and inflation ate away the purchasing power of bonds and cash, which were disproportionately held by the rich. As you can see, this is where we are today. The author says right in here that as the government started paying a whole bunch of money, they tried to raise the taxes on the rich, and inflation ate away all the purchasing power. In the 1970s, there was a rapid increase in wages and bank lending, along with the rising fiscal deficits. Once again, we're talking about government deficits again. Commodity shortages negatively affect poor and rich people alike. Financial assets like stocks and bonds, primarily held by the rich, performed very poorly, while real estate with a mortgage attached to it did quite well. Labor unions were still near at the height of their power, which caused various issues, but also kept wages pretty high for the bottom 98% until their power weakened in the 1980s. The unions are at a low. They're at one of the lowest points for union membership in history. So this could be an issue in the future where the unions aren't there to help wages continue to go up during an inflationary period. So wages could be stagnant, is what this is kind of leading to. As union membership has fallen, the top 10% beginning a larger share of the income. Let's fast forward to the 2020-2021 numbers. Based on data complied by the Federal Reserve, the top 1% of society currently has 31% of the U.S. household net worth, while the bottom 50% of society currently has 2% of the net worth. The average member of the top 1% has a 775 times as much wealth as the average member of the bottom 50%. More specifically, the top 1% of households in the United States have $39.4 trillion in assets and less than $0.8 trillion in debts, which gives them a net worth of $38.6 trillion. So they have a debt to equity ratio of just 2%. Almost all their entire balance sheet consists of assets. Meanwhile, the bottom 50% of households have $7.6 trillion in assets, $5 trillion in debts, resulting in $2.5 trillion in net worth. So they have a debt to equity ratio of 200%. Their balance sheets have a lot of debt relative to their equity and almost as much debt as their assets. This is something a lot of people need to understand. As the debt to equity ratio of the rich is 2% versus the debt to equity ratio of the bottom 50% is 200%. You need to have more assets and less debt. Inflation is good for debtors and bad for collectors, since many types of the debt get partially inflated away when inflation runs hot. The very lower class tend to have more liabilities than assets. The working and middle class tend to have only moderate more assets than liabilities, and with most of their equity tied up in a house offset by a mortgage. When inflation happens, the highly leveraged balance sheets do a lot better than the under leveraged balance sheets of the rich, especially because of the types of policies that tend to be inflationary. High wage pressure from unions or government transfer payments to citizens that increase the broad money supply tend to benefit the non-rich and tend to be funded by increased taxes on the rich. While high inflation that runs above prevailing interest rates is also primarily an indirect tax on the rich, as the vast majority of cash bond stocks are held by the rich. Hyperinflation, which is a different subject entirely, tends to hurt almost everyone, especially the poor, and society has a risk of breaking down into a failed state. However, historically and mathematically, moderate to high inflation within the context of an intact state tends to reduce wealth concentration. There are, however, some groups in lower income brackets that do poorly in inflationary environments. If someone doesn't have a lot of money and lives on a fixed income in retirement, they have a lot of vulnerability to inflation. Those sort of folks should consider owning inflation hedges to protect their lifestyle if they expect that high levels of inflation have a reasonable probability of occurring. If we consider cultural cycles, moderate to high inflation often comes from uh, political environments and policies after a period of disinflation and high wealth concentration that occurred in establishment dominated political environments and policies. The political pendulum swings back and forth between the interest of capital and over labor over the ages as different groups gain control for periods of times. Problems tend to arise when the balance shifts very far to one side or the other, resulting in rapidly shifting public opinion to push it back the other way. I think in today's environment, you're seeing that pendulum shift really far left and really far right in today's environment. Capital had political control from the late 1800s to the 1920s. Labor had political control from the 1930s and 1970s. Capital again had a political control from the 1980s to the 2010s. I'm not sure what's next, but the signs are increasingly pointing towards labor regaining some influence, and that's a topic I continue to monitor. The biggest loser asset class in inflationary environments are cash, loans, bonds, any sort of fixed income system. In other words, if you disproportionately own liabilities in other entities, you're the one that gets the bill. Stocks depends on the starting valuation. If you bought stocks shortly prior to or during the inflationary World War I period, you outperformed Treasury notes by a moderate margin. If you bought stocks shortly prior to or during the inflationary World War II period, you outperformed Treasury notes by a huge margin. Stocks were quite cheap during both these periods. In contrast, if you bought stocks shortly prior to when the inflation began in the late 1960s into the 1970s period, you underperformed bonds and bonds did poorly too. So it was bad all around. It depends on specifically when you bought, though. If you bought after a big stock corrections during the period, you generally outperformed bonds from these points. Stocks were quite expensive in the late 1960s, but became cheap in the 1970s as inflation ran hot and policymakers increased interest rates. Whether the broad stock market does good or bad during an inflationary market compared to bonds historically depended mainly on the general valuation level of the stocks going into that period. As for sectors, value stocks generally outperformed growth stocks in inflationary periods. Real estate, mostly a short leverage trade. Home prices performed poorly in inflation adjusted terms during the inflationary 1910s. Home prices performed very well in inflation adjusted terms in the inflationary 1940s. Folks who bought homes prior to the inflationary 1970s generally saw the property remain flat in inflation adjusted terms. However, folks who had property with a fixed rate mortgage going into the 1970s generally did very well. The house price kept up with inflation, but the mortgage was devalued against inflation, and so the home equity went up quite a bit along with their wages. Commodities, deflation, terrible, inflationary, great. Commodities are historically poor performers in the long run, since gains productively usually make them cheaper over time. However, they were generally massive winners during inflationary periods. Oil, as the key commodity during the 20th century, performed well in all three inflationary decades. This was basically an axiom. High oil prices are basically what define inflationary periods as a key input. A summary of the author's thoughts. Inflation is a rather complex and controversial topic, but we do have a good set of history and numbers to work with them. As a recap, there are important relationships to keep in mind for inflation and its various terms. Monetary inflation, meaning a rapid increase in the broad money supply, is driven either by an increase in bank lending or large fiscal deficits. Whether this leads more to asset price inflation or consumer price inflation or neither depends on a few variables. Interest rates. When interest rates rise, it puts downward pressure on most asset prices. As we saw in the inflationary decade 1970s, when interest rates remain low, the monetary inflation remains decent environment for asset prices, as we saw in the inflationary decade 1940s with the market bottom in 1942. Pendulum swings, whether the balance of power favors the wealthy due to some combination of offshoring, automation, or political environment, the monetary inflation is more likely to translate into asset price inflation. Whenever the balance of power shifts towards labor due to onshoring labor organization and or populist politics gaining the foothold, the monetary inflation is more likely to translate into consumer price inflation. This is largely correlated to wage increases or lack thereof, as well as being correlated to the size and scope of government transfer payments and tax policy. Commodity scarcity. When commodities and other resources are abundant, with supplies outpacing demand, it keeps input costs low and puts downward pressure on consumer price inflation. When commodities are scarce, with demand outpacing supply, input costs start to rise and puts upward pressure on the consumer price inflation. Technology revolutions can also cause massive productivity gains that create commodity abundance for this period of time. In terms of investing, there is no guaranteed rule, since each inflationary or deflationary period has different reasons for happening, but there are some consistencies. Inflation. During periods of moderate to high inflation, gold and commodities tend to do extremely well. Equities outperform bonds more often than not, but it depends on the type of equities and their strong starting valuations, and therefore having huge variance. Real estate does well, mainly because of leveraging attached to it is melted away from inflation. Bonds do poorly in inflationary environments. Deflationary stock. If temporary deflation is caused by deflationary stocks, such as a recession or depression, bonds are the place to be and outperform everything else. Gold also generally does fine compared to other assets. Stocks and commodities usually perform very poorly. Productive deflation or disinflation. Bonds and stocks do well in periods of strong real growth with low inflation and high productive gains. Between the two, stocks can do better. Commodities and gold are prone to poor performance in this type of environment. My base case going forward continues to be that with the combination of sizable broad money supply growth along with public opinion pushing the pendulum back away from globalization, consumer price inflation is likely to be higher in the 2020s decade than it was in the 2010s decade. So that's the article. I think it's a good read. I'll post a link below for you guys to read the article in full and really dig into the charts. Tell me what you think in the comments below about what's going to happen in the next year or two with inflation. Do you think it's going to go pretty high? Do you think it's going to just be transitory? It's just going to basically go up and then back down again to where it was before? Do you believe that the inflation rates are going to be transitory? They're going to go up high, but then they're just going to kind of stabilize. You're not going to see a real decrease in prices. Tell me in the comments below what you think and what your opinion is in the future.